This video is part of the featured stock series brought to you by PolarisInvesting.com, a site for creating defensible valuations. This video is provided as a cursory example of how to value a stock and is not an exhaustive analysis. As a reminder, valuation is a craft requiring skillful balance of past facts with future possibilities. If you're a frequent viewer of the featured stocks series, you may want to forward to around the 5-minute mark to skip the following additional reminders. As a reminder, the purpose of valuation is to improve the likelihood of a higher investment return by recognizing when prices deviate significantly from business value, as shown in the graphs at the bottom of this welcome screen. The straight line represents business value over time. The oscillating line represents market prices. Buying at a price significantly below current business value increases the likelihood of a favorable investment return. Before we get going, I want to remind you that the date of this video is shown under the company name on the ticker page. The title of this video is appended with the word prospect or suspect. Prospect means that the conclusion of this video is the stock is worthy of further consideration. Suspect means is not recommended at this time. Also, as a reminder, let's quickly review the valuation formula used by PolarisInvesting.com. The valuation formula consists of 6 inputs shown at the bottom here, from sales growth, profit margin, price earnings multiple, future shares, years in the near term, and the cost of equity. Sales growth and profit margin are the 2 most important inputs. In fact, sales growth is the primary input and can be entered directly through the Polaris ticker page. Profit margin can be indirectly entered through the sales growth slider. Importance of sales growth and profit margin are called out by Gary Gray, a professor at the Wharton School of Business. He wrote in his book, Valuing a Stock, "The ability to forecast sales and profit margin is what separates the all-American stock analysts from their lower paid kin." The other 4 inputs, the price earnings multiple, future shares, number of years in the near term, and cost of equity, have default values that are usually reasonable. It should be pointed out that the future price earnings multiple is what the Polaris Investing valuation formula is built around. It assumes that in the terminal value period, that the rate of return that a company earns on its project mean reverts to its cost of equity. Over here is shown the exact calculation of the PE multiple. But when you assume this mean reversion, you have a defensible value for the future price earnings multiple, as opposed to using some historical average. Well, now that we've reviewed the inputs used by the valuation formula, let's briefly discuss the formula itself. If you recall, in general, any valuation formula is the present value of near-term cash flows plus the present value of what's called the terminal value. So what Polaris does is it takes the current dividend, multiplies it by 5, which is considered the number of years making up the near-term cash flows, and then adds to that the terminal value, which consists of the current sales times the growth of those sales for 5 years, times the future profit margin, which gives you future earnings, times the future mean reverted price earnings multiple, which gives you market capitalization, which is just simply price times the number of shares. You divide by expected number of future shares, and that gives you a price per share, and then you just discount that back for 5 years, add it to the first term, and the sum is business value. With a review of the valuation formula used by Polaris Investing complete, Going to now discuss the featured stock. This featured stock video, we're discussing United Rentals. You can see here when we go to the PolarisInvesting.com site and take all the defaults, the practical investment return is 15.8%. So it's definitely a stock that is worth looking further into. To get familiar with United Rentals, let's look at some background information. We scroll down here at the bottom of the ticker page. We see here that the sector is industrials and the industry is business support services. It is considered to be in a cyclical type business that we'll see as we go through more of the background. The market cap, $9.5 billion. The number of employees is approaching 20,000 employees, primarily through over 1,000 different branch locations across the United States and parts of Canada. Does not pay a dividend, has a dividend yield here of 0. But the average volume is reasonable per day volume, so you're not buying into a thinly traded stock. Another thing we notice here is the shares trend. The company has announced as of about a year ago fairly aggressive repurchasing of shares, and we see that here with a minus 3% indicating our stock repurchase. Let's also look at some other information that was discovered just upon a real quick look on the internet. Here's a brief company overview. You can see here that the industry that's part of is very fragmented, but United Rental owns has captured around 13% share of the market. As mentioned earlier, there's the number of locations across North America, a little over 1,000. I want to read at the bottom here, though, that the URI is the largest player. This gives them two major advantages. One is its purchasing power with its supplier, and the second is the high utilization rates it gets from its equipment by sharing between its branches. The industry that they're in, the companies primarily compete on price and availability. The main strategy that URI has pursued since it went public in 1997 is what they refer to as a roll-up strategy, which is aggressively growing through acquisitions. Since they went public over 20 years ago, they've acquired over 275 different smaller players, funding primarily with debt. Taking a closer look at their debt, see here that debt they have is considered junk rated. Over 30% of the debt is also variable rate, so it's susceptible to short-term interest rate fluctuations. Another thing of note is, why do customers rent from companies like United Rental? Well, primarily is managing risk in their inventory expenses. Equipment that they need on a job typically varies quite a bit from week to week, so that instead of owning all that equipment, they can rent it as it's needed. You don't have to worry about maintaining the equipment. Note that most of the rentals is in non-residential, primarily in commercial. And in the commercial space, a good chunk of it is in oil and gas, dealing with the handling of liquids for fracking. With that brief background, let's get back to the PolarisInvesting.com website and discuss the valuation. First thing you notice here is the operations type is considered stable. There is not excessive R&D because they simply buy their products from other goods and rent them out. There has been positive earnings over the last several years, so it's stable in that regard. Shares have been fairly stable. The biggest concern is their debt load. Well, next let's look at price momentum. You see here has fallen relative to the overall market over the last 3 months. Well, let's do a deeper dive on price history. What you're looking at is the price history over the last year. The bottom darker blue line is United Rental, and the top lighter blue line is the S&P 500 index. As you can see, URI stock price started to significantly diverge from the S&P 500 index about 6 months ago, and over the last year its price has declined by almost a third. Now its upcoming earnings report is due to be out, looks like here in about 2 weeks from the time that this recording is taking place, so need to be a little bit aware of what may go on around that earnings report. It looks like here past over time there may have been some surprises around earnings reports that have caused the market to react. So trend is definitely down, and a lot of that is due to the large debt and the perception of the market that interest rates may be going up. Looking at recent financials, the income statement in particular, we see here that the earnings per share year over year for the last several years has been showing a pretty significant increase. And when we look at the forecasted numbers from the analysts, we see good earnings growth being projected here of almost 17.5%. There is a little troublesome dip here in the current quarter that they're going to be announcing here in a couple weeks that looks like something you need to be looking out for as to whether that turns out to be as negative as this seems to indicate or the forecast is. But further out for forecasts have for pretty substantial growth in terms of earnings. And also you can see here growth expectations is around 15%. Scrolling up, see here that the analysts, 15 analysts that were polled by the CNN site, have quite a range of valuation, but the mid-range is quite much higher than it currently is. But that could be based on past information, and we could be looking at a value trap. So we need to constantly be questioning these forecasts. Okay, returning to the Polaris site, we see here that the default sales forecast is 10%, so that's several percentage points lower than what we saw on the CNN site. But even with a 10%, seeing a fairly high theoretical valuation, and then the practical valuation fairly significant, also above the current price. United Rentals held an investor relations conference in mid-December, so about 4 months ago. And in that conference, they were very positive on the outlook of their business. So I'm going to keep the sales growth slider set at a default of 10%. So let's go down here and look at the sales growth graph. If we take out the theoretical and take out the S&P 500, we see that what that's assuming then is we're going to go from around $8 billion in sales here this year, and then we're projecting out that in 5 years with around 10% sales growth, that we'll have a little over $11 billion in sales, which seems reasonable. Let's next go on to profit margin. If we scroll here to the bottom, we see here that the average profit margin has been 12.9% over the last 5 years, and the projected future profit margin is also 12.9%. We'd also go out and look at the graphical history of the profit margin, and except for the most recent year, that seems like a reasonable average profit margin to assume into the future. Well, now that we've looked at the primary input used in the valuation, which is sales growth, and also the secondary most significant input of profit margin, let's just do a quick sanity check on the third input value that weighs heavily into the valuation. That's the future PE multiple. Now recall the valuation formula used by Polaris Investing is centered around the future PE multiple, so it's really needing to be modified. But again, as a quick check, we just take 1 divided by 1 less than the PE that's currently being shown, and that tells us roughly what the cost of equity implied by the future PE. So that's roughly 10% cost of equity, which on the surface seems a little bit high, but this is talking about a cost of equity 5 years out. And with the strategy that United Rental has in the use of debt, that high cost of equity is likely warranted. If we were to lower it down a little bit, it would just increase the PE and then make the valuation even higher. So we've already got a pretty high valuation relative to the current price. So it makes sense just to leave the future PE where it is. All right, so let's see where we're at relative to the formula that's used by Polaris. We factored in the growth of sales, future profit margin. We've looked at the future PE What's left is, yeah, we saw a little bit of buyback going on, but I think that's reasonable with what's been discussed in the news by United Rental. And the cost of equity is quite high, as we see here at 12%. But again, based on the amount of debt, that seems reasonable. Now, one last thing, I want to make sure we remember that there is no dividends being paid by United Rental, so this first part of the formula is zero. So we've accounted for all the inputs into the formula. So now it's time to talk about other things to consider that are more qualitative. One is what is the recent news? Has there been something that, we saw that the stock has dropped relative to the overall market about 4% over the last 3 months, but really no news has really driven that. It's just more about the macro and events and interest rates possibly going up that I believe is more responsible for that because again, with the amount of debt that United Rental has, they're very susceptible to interest rates. Now, recently the Federal Reserve has said that they're going to hold back on as many interest rate increases as they once said they were going to do this year, and some are even suspecting they may even lower interest rates because of the state of the economy. The other thing to keep in mind is Trump, in one of his political promises, said that he would get around to enacting infrastructure spending. That would be positive for United Rentals. Management guidance, earnings surprises, that kind of thing. Actually, the management has been going out of their way to, like with this investor relations conference in December, to keep telling the marketplace that it feels like its business is in good shape. Now let's talk about their strategic competitive advantage, which is often referred to as a company's moat, or some even refer to it as the dead zone, meaning if anybody tries to come into this area, they're going to meet up with a lot of competition by a specific company. Well, for United Rental, their moat is primarily brand, which they offer a low-cost search. In other words, people, when they need a backhoe or something like that, they just default to United Rental because that's who they've dealt with in the past and know that they're available across a wide area of the country. Also, as economies of scale as part of their competitive advantage or moat, the bigger they get, the lower their costs are. Network effects, which means as more people use the product, it actually becomes lower cost because they can lower their costs with their suppliers. They also can do more sharing across their branches, so they don't have to buy as many products as their customer base grows. They also have key customers and suppliers, particularly customers that deal with projects that involve going across states, federal government type projects. It's just easier for that customer to deal with a single company across states as opposed to dealing with a lot of smaller companies. Overall, the strategy of United Rentals is fairly straightforward. They're just going to try to continue to grow like they have for the last 20 years and consume or take on and capture more of this very fragmented market. As they take on more market share, they are assuming more and more debt, but that's just the trade-off with this kind of a strategy. And what they're hoping to eventually gain is what Warren Buffett likes to call a consumer monopoly, which is a kind of a durable brand. And it's just what everybody, when they need this kind of service, it's who they immediately think of, and they're just down the street from wherever a company may be located, so they're readily available and just become the default option for this kind of work. Other things to consider are like board of directors and just the general ownership structure of the company. Well, the good news is that Michael Nealon, the founder of the company, is still the CEO 20 years into the company. He's around 65 years old now, but no signs of him stepping aside. Accounting, there's been no accounting issues. No other stakeholder, employee, unions, local governments, anything like that, nothing like that has come to light. Okay, as we begin to kind of wrap it up here, I want to go back and look where we are. We haven't changed any of the default values. We're right there with 15.8% as a practical valuation, annual return. So at this point, it's worthwhile to kind of step back and just think about yourself and think about whether, as we're doing this exercise, are we getting caught up in maybe anchoring the valuation based on the current price and based on the recent trend of the price. I feel like we've done a good job here to take a look at the historical pricing, understand where it's been at, and then try to take a totally independent account of what the appropriate valuation would be. Another thing would be considered whether we've just been maybe oversimplifying the situation, but it is a fairly simple business. It is simply buy equipment, lease it out. There's not a lot of R&D involved with what they do. The strategy is clear. They're just trying to take on more and more of a very fragmented market, and as they do that, it takes on debt. But when you take on debt, the trade-off is that you're susceptible to interest rates, and therefore why we've likely seen the market bring down the price here recently as interest rates have fluctuated around. So to finish up the thinking around United Rental, let's go down here and look at the expected price that we're building in here from a practical standpoint. We're assuming that we start off with a price here of about around $114, but in 5 years out, we're thinking the price could go up to $238. And that's an annual increase of around 15.8% per year. So that implies that we're going to be doubling our money in a 5-year time frame. And for the kind of strategy that this company has in terms of what they've been able to do to grow their share, there's lots of opportunity out there for them to continue on with their strategy. So the conclusion for United Rental is that it's a prospect. With the analysis of the specific featured stock now complete, the following are general suggestions to conclude every featured stock video. If you are a frequent viewer of featured stock videos, you may want to skip the last 2 minutes of this video. It is recommended that at least 1 week be used as a cooling off period before taking any action. It is important to take some time to reflect on the analysis. If you decide to take a position in the stock, initially only invest 40% of your total planned position. It is worthwhile to have downside protection as you take your first position in the stock. It is suggested you buy a put option at a strike price 20% below the current price. If a put option is prohibitively expensive, use a stop loss order instead. But beware that a sudden bad news can cause the price to jump beyond the target stop loss price before the order is executed. So it is not guaranteed protection. If you could be making your initial investment around an earnings announcement, it's suggested that you invest half of your initial investment before the announcement and the other half after the announcement. Another recommendation is consider increasing your position after price movements of 10%, up or down. Limit each additional investment to 20% of your total planned position. Before investing more, assess the current situation. Follow the buy, sell, watch recommendations from the investment plan you created on PolarisInvesting.com when you first took a position. Recall, the investment plan recommendations change as price and valuations change. So check again before investing. One last recommendation is recall it could take up 3 to 5 years for an investment scenario to play out. So you must be committed. Committed comes from doing your own thorough analysis and independently making your own decision. Do not simply follow the recommendation provided in this featured stock video. If you're interested in other featured stock videos, they're available on the Polaris Investing YouTube channel. Well, thanks for watching.